We should be. It's 760. That's all right. Pixels.
Oh, okay, that's what I was going for. Alright, so I'm going to start off with the boring part that I did last time. My presentations. How to trade options. Really. More disclaimer, so on and so forth. What you're taught, media academia professionals often teach about ideal trading situations. Truth is, they suck. They turn you into the crowd that we as technicians strive not to be. Like for instance, Peter Jarnes suggested buy out money call put options right before Apple's earnings. What he didn't mention is that if you would have bought the calls and puts the day before, because of volatility premium, they would have been 50% cheaper. But no, they don't need to tell you that. They don't even know about that. Okay. The entire audience was pleased that the day after earnings, even though the stock moved, even it moved in their direction. Why? Because they forgot one key ingredient in the options market. Okay, basics, going past the basics. You know what strike price means? Basically, bro, that didn't look at Investopedia. Do you know what a strike price is? No. Alright, strike price. You do an option contract that either gives you the option to buy or sell a stock at a predetermined price. That predetermined price is the strike price. Alright, next one. Call option gives you the option, not the obligation, option to buy 100 shares of a stock at that predetermined strike price. Put does the exact opposite, gives you the right to sell 100 shares of stock at a predetermined strike price before the contract expires. Okay, profit and loss diagrams. Y'all familiar with these? It just shows you different strategies. It is above this line, this is the zero line. It's above that line, you're making money. We'll just call this axis the stock price. It's below this line, you're losing money. They normally do them at expiration. So on expiration date, for instance, a short butterfly would look like this. So if the stock was there, you lose a bunch of money. If it was up there, you make a bunch of money. That's the one for a call.
Quick question.
Yeah.
I've never taken an options class. Do they teach this in options class? These diagrams?
Alright, they teach you in 4 cents. Strike price, 40. As you see, it goes up, you make money. Strike price, it's the exact opposite for put. Actually, I have it right laser right there. Where the further the stock goes down, the more money you make. The further it goes up, you're losing money. Option lingo, forget about it. No, out of the money, which means the strike price, which means the option, if it expired, would be worthless. At the money, same exact thing, but it's at the exact stock price at the time. In the money, if you exercised at this point, you would have a profit. Okay, so that dude. How to trade options. Really, part 2. Trading single calls and puts. Forget about it. That was the wrong title. Okay, never trade options without a good reason. I mean an excellent reason. Options are terrible animals. Taking a quote from the second Wall Street movie. When you trade them, you'll consider them a bitch that never sleeps. And as soon as you start trading and you start losing money, you'll know why. Okay. Reasons that are not valid, reasons that they teach you in class, reasons that the media tells you about, and reasons that you might just think up on your own. Reasons that actually give you an edge over trading the underlying stock or whatnot. So the whole idea of trading an option versus a stock is that it's going to give you something, and there's like options on these two, but I'm not even going to mention those. The entire reason to trade one over an underlying like a stock, well, you need to have it. If you don't have a reason to do that, then why trade it at all? Not just for fun. Fun doesn't make you money. Okay, so first good reason, the option is valued in a way that I know I'm getting a bargain. Now I'm not saying like a 410 class or a 406 Black-Scholes situation where we're doing arbitrage. I'm saying that relatively, I'm saying it's fairly valued, other things considered, but compared to previous times, it's actually undervalued. The type of options that I'm trading could both my time and price objectives better than just buying or selling the stock. As you probably know, if you sell stock, you expect it to go down. If you buy stock, you expect it to go up. with options, we can make profit and loss diagrams that look like that, and that. So we can basically customize our own trade. Okay, so option lingo part 2. Black Scholes, I just mentioned that. It's just a pricing model. I'm not going to go into formula. But there is one variable in it that's called implied volatility, which measures the cheapness or expensiveness of a stock. And it is determined from the crowd. Yes, okay, so as you see, volatility, you can't actually calculate it. You can calculate all these other ones, but you can't calculate that. You have to see what the actual option is trading at, and then you can take the implied volatility by calculating it from market price. Implied volatility, like I said, just measures the relative premium or relative cheapness, expensiveness of the stock. Fluctuates generally within a range. It doesn't go through the roof. It doesn't trend like stocks. Usually increases when stocks go up. With commodities, it usually increases. Wait, hold on. It usually increases when stocks go down. It decreases when stocks go up. So when markets are moving up like they have been, you're going to notice that options are very cheap. But in August, the same option will probably be twice as expensive as it is right now. In panic markets, implied volatility prices of options go through the roof, like unreasonably. And before company events like earnings, like I was saying with Apple, you'll notice that the options, if you went to the day before earnings versus 2 days before earnings, they're going to be even more expensive for no reason at all. Just company events because everyone wants to take a gamble. And the market makers are selling you that option. They're more than happy to oblige you pay the price, which you're definitely willing to because dumb money doesn't even think about this. Examples, okay, how often prices change with volatility? Yeah, look at my least favorite stock, Apple. So, let's see if I can actually do this.
It's a hard decision. I ended up, since I didn't want to follow that with motivation, I know it would have been good for me as well. But,
okay, so we direct attention to those two screens now as I open this up.
So if you enter in the fall, when you start with
I think there's like a week gap or something. It's nice of the summer though. It's always a good move because it was a good time. Oh, okay, really? He is the guy he's the best kid.
So,
But you should be fine.
who is making money in a competition right now? Really?
what
Who's losing money in a competition right now?
I thought this was like
I would definitely.
Alright, what'd you do? Adam Lacey, what did he do?
I was pretty sad on that.
The Northwestern interview, Northwestern Mutual.
He didn't even break
Maybe
out.
just and even if you get it, then
Are you out of it now?
you can always
Oh,
like,
yeah.
you can always
Good.
not go.
Well,
Or
You can
short
always
some
decline
bonds,
off.
TBT.
You obviously don't decline after you accept it because that's for that.
75%.
Like you can
What
always
do you have
say,
right now? How much?
thank you,
What's your account value?
So it's good to have that opportunity.
Oh, bro, you better make that back. Alright, who's in second place? Who is 110 right now?
Oh yeah, but that's all I have here. I'm gonna go.
There we go. Looks like we do have a new first place. Okay, so
Take it easy. Thanks for coming. No problem.
and sorry in advance. I do think this meeting's gonna run a little bit long tonight. So if you have to leave, I don't care. It's totally fine.
Oh, county quiz. When?
the 211.
That was Adam.
You know, now they made all my account
Sorry,
and everything, so you just do it online.
Are you gonna do more options? Yeah.
Best of luck, man. I don't think I'll need it.
Okay, so let's take a look at when was Apple's last earnings announcement? Actually,
PlayStation?
It's so dark in the back.
It is.
yeah.
It really makes me depressed.
Can you actually pause that a sec? Unless you want to actually zoom in on one of the screens.
Yeah, I zoomed it in. It's good.
Apple's last earnings announcement was. Will somebody read it off when I highlight? What was that? What time? So it was an evening announcement? Okay, so let's go to call option, end of day price. So we're gonna do Apple. You said February 23rd? January 23rd. Okay, so is that the 23rd? Yeah. Okay, so January 23rd, I'm gonna do the front month, which in this case would be that one. Is this just the call and the puts? Yeah, so the at the money call is, let's see, the 430, we'll just go with that one, is 1370, and I hope this works. Might not work. We go to, so I did the 23rd. We go to, let's say, the 18th. Alright, well, we'll put it this way. In general, when there were earnings, the premiums would go up a lot. And actually it's because the stock went up that day to above where it was before. But just something to consider. Alright? Go back on me. Okay, extremely important concept. IV, that's going to stand for implied volatility. Buy when it is low, so buy options, buy calls, buy puts. Sell options when it is high. So, for instance, August comes around, the VIX is up above 40, everyone thinks the world's going to end. Who cares what your direction of the market view is? No matter what position you're going to take, you want to sell options, whether it's bearish or bullish. Never buy them because you're getting ripped off. Now, at this point, whatever direction you think the market's going to go, buy options. The VIX is down below like 18, super cheap. Okay, so real situations in which to trade. Like I said, pretty much what I just said, bullish on a stock and the implied volatility is low. You would short a call when there's high implied volatility and you're bearish. So on and so forth. Okay, so now we jump to looking for trades. All right, part 3, spreads and brief. Let's go lightning speed here. Okay, option lingo, part 3. There are two kinds. Well, first, a spread is when you trade 2 or more options in the same trade. So, for instance, like, well, a simple call option, if you wanted to buy a call option, it would look like this. You could buy a call option and you could sell another call option at your target and it would look like that. Now the advantage to that one, you're going to take less risk because by selling that call option, you're going to get extra premium, so your potential loss will be lower. That's called a vertical. Downside, when you do a vertical, so that would be long call. A call vertical, the same strategy, would be called a call debit. Notice you cap off your profits at a maximum price. So for instance, I'm long a lot of call debit verticals on gold and oil right now. Because I can wait, but I really don't care at this point how much it goes up, I just think it's going to go up. So I'm that right now, and also the implied volatility is low. Debit spread, you have to pay initial cash to open the position. Credit spread, you get cash to open your initial position. The thing is, when you have a credit spread, your maximum gain is what you took in. So you get the initial money, and you hope you don't lose anything. With a debit spread, you pay the initial money, and you hope when the option expires, you hope to exercise the options and then take your profits. So one has time decay working for you, one has time decay working against you. I tend to like to be an option seller, so I tend to like to do credit spreads more often, but still you have to obey that law of volatility. So when volatility is high, you sell. Call credit, put credit. Notice that the call credit and the put debit are the same exact strategy. Same with the call debit and the put credit. So a call debit would be you buy one option that has, like let's say Apple, 600 strike price, you sell the 605. call credit, you're expecting it to go down. You sell the 600, and then you buy the 605 to protect it. Put debit, you would buy the 605 put, and then you would sell the 600 put. Put credit, you would. Anyone want to help me? I'm getting a brain fart.
You sell the higher strike price and buy the lower strike.
Exact opposite. You sell the, oh, wait, no, you're right. Never mind. You sell the lower strike price and then you buy the higher. No, you're totally wrong. I'm gonna skip over that. Skip it over that one. I got a brain fart, sorry. Or to be politically correct, brain weave. Okay, so next one. Debit spreads, easier to understand. Like I said right there, say you want to sell a call for 25 and then you buy a call for 50 at a lower strike price. Difference is 25, so it costs $25 to open the position. Credit spread. You're giving cash. You want to see how much of the cash you'll have to give back. Hopefully, you won't need to give back any of it. Okay. Jim Cramer lightning round now. Option strategies and spreads. I'm going to go through each one right now, what situation you use each one for. Alright, so first one is a single. That would either be long a call or buy a call. Buy a call or buy a put. Buy a call when volatility is low, expect the stock to go up a lot. Long a put when volatility is low, expect the stock to go down a lot. Vertical, that's all of these up here. You have a maximum loss and a maximum gain. There's no infinite anywhere. So they're good. You expect the stock to go up or down, but you don't want to put all of your eggs in. Free trade. That is when, for instance, it's basically getting into a vertical. So let's say I buy. Let's say I buy Cabela's, which is an actual trade I did. I buy Cabela's 25 call for $470. Okay? I wait, it breaks through a symmetrical triangle, goes up, keeps going up, and then I start to see signs of weakening. So it weakens around, I did this around $28. It starts to weaken around 35. So I'm thinking, well, that's the price mark for the pattern. I think I'm going to hedge myself. So then I will sell. Well, in the meantime, this call has gone up to $900. So I'm sitting with a $530 gain. I'm happy about it, but I want to keep it because I need to wait for the option to expire. Plus, anyway, I'm a little greedy. I want a little bit more. So I sell the Cabela's 35 call. And this is as the stock is at 35. And because the stock went up, that call is now worth the same price as I bought the first one. So it's $470. This is an excellent strategy to keep you from getting greedy and giving back your gains. So I bought a call for $470, and then I sold a call $10 higher for the same exact price. What does that give me? It actually takes this trade right here, the call debit, and it takes that formation that you just saw, and it turns it into this, where this was 25 for the stock price, and this would be 35. So what does that mean if it looks like that? What's the really good thing about this trade? Yeah, I can't lose anything. So my maximum gain, if it expires above 35, I make $1,000 instead of that 500, and it doesn't even move anywhere. If it goes down, say we hit a new bear market, drops below 25, I don't lose anything. Other cool thing about it, this trade, it was free. I did not need to put any of my cash into it. I put cash in it initially, and I sold a position that gave me back that cash. So now I have two positions that zero out each other. But still, as long as I wait, I can make $1,000. It's pretty cool stuff. Did you have a question, Brad?
No.
All right. So that's a free trade, or another thing would be, another way to be called would be legging into a vertical. So legging in means you take one position, then you wait a while, get a better price, and then you get into the other part of the position. Next one, butterfly. This one up here. If you have a conviction that the stock market or something is going to be a specific price at a specific point in time, and you think that you can pinpoint it, you do that strategy. So, for instance, and I was totally wrong on this one. I thought the Dow Jones would be at 12,500 last week. So I did a butterfly. This is cool. Strategy, and you can look up the actual strategy, like how you do it online. I'm just telling you how it works. The strategy, maximum risk, $20. That's if it closes below that line. So $20. But if it closed close to 12,500 of the Dow Jones, I would make 1,000. So my max risk is $20, but I have a very slim chance of making a lot. It's like getting a lottery ticket and hoping to win it big. Very low odds.
But it was only for each share.
Oh, no, in that case, no, it was 20 for the entire thing.
Oh, for the overall.
So, yeah.
Oh, okay.
So in that case, it was 2 cents.
Oh, okay.
2 cents for each share.
Okay.
Yeah, so it
I
was.
thought you meant 20 on each share. I was
Oh,
like,
no.
this is like 2,000.
Hell no. But yeah, that's a good trade if you have a little conviction that it's going to be a certain point, a certain place in time. Next one, condor, non-directional spread. If you think it's going to be between a certain price and a certain price, you do this spread. All it really is, it's just a call debit, which looks like that. That's the first half, and it is a call credit. Iron condor, all it is the same exact principle, but instead it is a put credit and a call credit. Okay, so condor, you're buying stuff. When do you use that in terms of volatility? When volatility is blank, you would do the condor. When you buy options. Yes, okay. Iron condor, you're doing a credit spread and another credit spread, which means you're selling options when you do that with volatility. Yes, okay. Good. Next one. Collar. Screw the collar. It's basically the same exact thing as a call debit, except you use stock too. Diagonal. Diagonal looks kind of like the butterfly. I forgot to draw this one. Like the profit and loss thing looks like that, and it normally covers a very wide range. The idea of the diagonal spread is that you, like say for instance, you would buy a DXX call, 25 call, and then you would sell the next month, 27 call. And it just works, it just makes a 10. I never traded those, but they're very good strategies. Synthetic, you buy a call, you sell a put. It looks exactly as if you bought the stock, and all you make it simpler. It looks exactly as if you bought the stock. It's very, very directional. So if one of these goes against you, you lose a ton of money. Straddle, strangle. These are spreads that you think that the market's going to move like crazy or single stock, but you have no idea what direction it's going in. So if you see the market in a symmetrical triangle, you don't feel like waiting, implied volatility super low. Like, all right, I don't care what way it goes, just go somewhere. Straddle is buying a call and put at the same strike price. Strangle, call and put at different strike prices. Free trade pyramid ratio spread. I'm just going to do a ratio spread. Ratio is where you buy one call. So say I buy my Cabela's 25 call, but then I sell 2 Cabela's 35 calls. So the idea is you want the stock to go up, but not too fast. If it goes up really fast, you're going to lose a bunch because you have a naked call. But if it goes up very slowly, protected against risk, or if it goes down, you're protected against risk. And if it goes right there, you make a lot. And I actually did that on gold last August. Yeah. Okay. So we went through that. Strategy playbook. I basically just said most of this. It just gives you a guide on how to trade these things, like the different spreads. As you see, if volatility is moderate, don't do the option. It gives you no advantage over trading the stock. So you either buy the underlying or you sell the underlying. If you have a conviction what direction the market's going, and it's low or high, then you can play some games. So as you see, if you have no idea what the hell's going on, go on vacation. All right, so we'll jump into risk management. Okay, I gave when Apple was at 450, I gave some friends, they said, I want to get an Apple, I want to do options. And I gave a strategy, and it was the first trade they ever did. They made $1,400 on a $1,000 account. They loved me, absolutely. They were like, you are fantastic, thank you so much. They decided they were professional day traders, and because they got all this high from the leverage they were using, they're down, they've lost half of it. It happens, don't get confident, especially when you mistake luck with skill. Okay, generally, risk the same amount of money you would in any trade, so if I buy the stock and I say, most all risk is $50, when you do the option strategy, most all risk is $50. Don't, unless you're really sure you want to do a little bit of leverage, but don't go crazy with it, until you get used to them, please. Okay. Options, stocks only require one stop. Options require 2, at least, maybe 3. First, the money management stop. A lot of option traders will say, if I have 50% loss, I'm out. That's all it is. It's just a, if I have blank percent loss, I'm out. Technical stop, that's what we do with the equities. So if like the previous support level is broken when we've already bought the stock, we'll get out because we think it's going to go down from there. Do that too. So if the stock goes down below support level and you're long an option, like a call, yeah, I'm definitely out. Fine stop. Options, especially when you're buying options, have time decay in them. That sucks. Think of it this way. You buy a call option on Apple. It expires a month from now. It costs you let's say $300, and every day the stock doesn't move. It doesn't matter that it didn't move down. You're going to lose $10 in time decay. So every single day for the month, you're going to lose $10. Eventually, if the stock just doesn't move at all, you're going to lose it all. So you got to use a time stop. So that means like if I did a straddle on a stock called Plexus, and I said, okay, it was 2 weeks ago, I said, if by March 5th it doesn't move in the direction I want, I'm getting out. And I did. I actually took about probably a 5% loss, but since then, if I would have held on, I would have been at 20 now. So that's the whole idea of risk management. Finally, with options, especially like I said, bitch that never sleeps, don't be dumb, stick to your plan. Option losses mount very, very quickly. Let's see. If you ever get one of those ego boosting times where you think you're a professional day trader and you trade an option, just watch as soon as you get in position, the spread's going to knock you down like 10% immediately. It'll be fun, so stick to the plan when you're doing options. All right, so exit strategy. Oh, no, it's done. Don't exit the day of option expiration because market makers, screw Goldman Sachs. I actually just got margin called last Friday for $25,000 because Goldman had the, I just blame Goldman, it's not like Goldman. They had the effing great idea of exercising a butterfly spread on me early, so I woke you up to $25,000 in the next 2 hours. I'm like, so market makers are idiots. Don't exit the day of an option expiration. Don't even exit 2 days before. At least 3 or 4 because crap goes wrong pretty quickly. Unless you want to, unless there's some positions, and if you're ready for it, you're not ready for it, and you're probably getting margin called, don't let it exercise on you. So you gotta have a plan. If you do get exercised on you early, consider it a trading mistake, get out. and it's always a good idea to hedge a winning strategy. So, like I said with the Cabela's thing, it can go down to $10 tomorrow. Would I rather lose $500 plus all the gains that I made? No, I'd rather lose nothing and just the gains that I made. Alright, so I flew the heck through that. Wow, I really did fly the heck through that. Any questions about anything? Like, I can show you how to get implied volatility graphs too. What's up? It was on a butterfly, so the two call options that I had, they hedged it. It's just the entire day I was getting phone calls. I'm like, don't liquidate a thing, please. And they're like, all right, you're marked, you're fine. So then I just got like $50 in commission on me for all that crap. So it was fine. The month before, when I had a $50,000 margin call on me, that was a little more difficult. Yeah, you can turn it